Lemonade Q4 2022. Let's talk about it. I want to walk through the letter and some of the highlights in the letter, and I'm also going to walk through my model and share a few graphs and interesting and really positive signs we're seeing from this quarter's results, and then also share a couple concerns that we could see from the letter, especially around the guidance, but also a couple possible explanations or rebuttals to those concerns. So let's dive into it. Overall, I really like this quarter. And some of the metrics are all continuing to rise on a quarter-over-quarter basis. As we'll see in a little bit, it's not so great, but year-over-year basis, really huge growth in in-force premium per customer, and total customers. Loss ratio is slowly, ever so slowly, coming down to 89%. We're at current right now. Gross earned premium, again, following that in-force premium closely, about 69% year-over-year growth. They give the top three highlights. They have top-line growth that's still growing significantly year-over-year, quarter-over-quarter, not so great. Loss ratio is coming down. They touch on that more later on in the letter, so we'll get to that. But then this is the most exciting part for me was that adjusted EBITDA losses and their overall losses were down to $52 million from $66 million in Q3, while net loss for the period was $64 million, down from $91 million in the prior quarter. And this was really important for me because management for about the last year has said Q3 would be peak losses. So if Q4 losses had been more significant, we would have been, I think, in a lot of trouble as investors. But because they are actually down significantly from Q3 to Q4, that's a very good sign, and their trend we should see is slowly decreasing or decelerating losses until we reach profitability in a few years' time. And they touch on how in the whole year of 2022 was the first time they had 5 products: renters, homeowners, car, pet, and life on the market, and how their loss ratio continued its uneven decline. They also mentioned how it was the year they acquired Metro Mile. And they also mentioned it's a year of soaring inflation, in which they filed 8 times more rate changes with regulators across the country as compared to 2021. And most of these is really important. Most of these rate changes have yet to be approved, implemented, and earned on. So we expect continued loss ratio improvement as they do. This is really significant. So basically, they're seeing inflation. Lemonade's filing rate changes, and the rate changes have to be approved, and then a new customer has to come in the door, or a customer has to reach the renewal period before they can be implemented, and then it's going to take time before that turns into gross earned premium and becomes earned. So it's a very lagging feedback loop or system here where these changes will actually take material effect. They talk about how adjusted EBITDA is continuing to improve, but it's even improving even more so if you look at adjusted EBITDA relative to the entire book of business. They talk about 3 things that are going to take them to profitability: cross-sells and upsells, loss ratio, and in-force premium growth. Cross-sells and upsells, which is annual, the metric they use is annual dollar retention. I will show you in a couple minutes here when we get to it, my model. I will show you the customer churn calculations where I'm at, and they're very positive of what we're seeing. They're saying their annual dollar retention is climbing. It's at 86%, a new high, reflecting how customers are increasing their number of policies and premiums per policy over time. We believe ADR will continue to improve, driven mainly by a more diversified product mix and an increase in our multi-line customer rate. Looking at Illinois, a state offering all Lemonade products for at least 12 months, and ADR is an annual metric, which it is, may offer a preview of things to come. This is really interesting. So Illinois, they went from Q4 2021 having all 5 products. They went from 87% having all 5 products available over that time up to 95% annual dollar retention. Annual dollar retention means you look at a cohort of customers from one point in time until 12 months later at another point in time. What dollars did those cohort have in premium at the start versus what amount of dollars did that same cohort have in premium at the end? So it's a function of how the customers inside that cohorts, their premiums might be growing over time, but also some of those customers might be leaving and then no longer putting dollars into that premium pool. So then you get to a 95% rate, means 95% of those overall dollars are going to stay in there, which is really, really significant. Obviously, some of these customers are adding to their product lineup, are increasing their overall premium per customer, but some of the customers are also leaving. But really, really positive effect versus everywhere else where it's more fragmented and where not every product is available everywhere, you're having slower growth. So you could expect as every product becomes available everywhere, we're going to follow a line more like Illinois is at. They talk about how the loss ratio is improving, even though there was this winter storm that had a catastrophic effect, which is obviously a really negative effect on loss ratio. They still had improvements in the loss ratio. So really, really positive. As we mentioned earlier before, loss ratio is also going to be affected by inflation and these the lagging kind of changes that can take place as they update rates relative to inflation. So that should see some really positive tailwinds for the loss ratio, I think, in the next year, 2 years. And they talk a little bit more here about how for catastrophic events they use their watchtower technology to try and mitigate the damage that would come from those. They also talk about AI Jim, who pays out the claims in record time and still keeps a net promoter score of 71, which is incredible for people that are paid out because of a catastrophic event. And they track here catastrophic events versus not catastrophic events, that their loss ratio improved about 5 points since Q3, but more like 9 points, or nearly 9 points in that same time if you're looking at non-catastrophic events that were factored into the loss ratio. So that's also a great improvement. And they talk about how they expect to continue growing, though then they kind of make it muted and then give some reasons. The reason why they're sort of giving here why they don't expect massive growth. They're only expecting 11 or 12% in-force premium growth over the 60-some% we're at year over year right now, because they're still sort of skirting around these inflationary areas where they know if they pile on customers, say in California, they want to add homeowners insurance, but they're waiting for rate changes to take effect. So at the current rates they could offer, they don't want to offer and pile on more customers because that's actually going to hurt their loss ratio further. They know those are going to be really unprofitable customers. So they're waiting for rate changes to take effect so they can offer more correct pricing to customers and then add on and pile in the customers at those rates. And they say we fully expect 2023 to see continued improvements in loss ratio, efficiencies, and growing with our customers. And that for Lemonade is the whole kit and caboodle. Jumping over now to my Lemonade model. I want to look at some more details here and then also show you a few charts. So total customers went to 1.8 million. Looks great year over year from 1.5, 1.8, but really quarter over quarter, we've had a really major slowdown in growth, only 1.7% quarter over quarter. And if you look at premium per customer, we only just under 1% quarter over quarter growth from $343 to $346 per customer. And this was expected from the last couple quarters. Earnings and earnings calls. Management basically said they're going into really conservation mode to try and preserve capital, slow down growth until inflation can catch up, until their own pricing rates can catch up. Then they're going to further accelerate growth. So it makes sense. And in-force premium, again, growing about 65% year over year, but really the quarter over quarter growth significantly less, only $609 million last quarter to $625 million this quarter. Look, and if you're looking out, I've sort of modified some of the numbers over the next year. It goes up to just over 700 million in-force premium by next year, which really is only a 0.5% increase in premium in total customers and a small amount of premium per customer from 346 to 389. And that's what I expect, probably less customer growth, more premium per customer growth. So the current sort of core customers that they're keeping, as they build up more products in certain markets where they're available, I think that more likely the customers will be kind of flat, might even be slightly negative, but the premium per customer will grow over the next year as they're really trying to preserve capital. They did say, again, they expect to catch back up to that 25% in-force premium, more of that kind of growth range after this next year. Should mention, if you want access to this whole entire model, you can get it by joining my Patreon and supporting the channel. Your support really means a lot. Annual dollar retention is really on a positive trend, was stuck at around, was below 80% a couple years ago. It was in the low 80s, now is in the mid 80s, 86%, from 84% last quarter. So that's a really positive quarter-over-quarter change. And as I calculated, my churn, which is the amount of customers that are churning or leaving from 12 months prior, took a big step change improvement, 5% improvement from 28% down to 23%. So that's really exciting, because just a couple years ago we were at mid 30%, even a few years ago 40% at the start of 2020. So 40%, 30%, we were in there for a couple years, and now we've been slowly marching down as more products are available in more places, and they're not sort of offering so much of a fragmented product lineup, but a more combined, bundled product lineup. And as existing customers that love Lemonade, love the product, or been with it, are getting older and less transient in their life. So slowly getting better, and actually significant change here, 23%. And we read about how in Illinois, they're at 95% ADR. So I want to punch in that. Say the all of Lemonade could move to 95% ADR, and they did that. Then if you did that, they're only at 15% churn, which is, I believe, close to what I modeled, 17%, sort of in the vacuum there, extending out years out. So I might have to adjust that down to 15% if that's more kind of what we could end up as. I'll change that back to 86 though, what it's currently actually at. Other insurance expenses are similar to what they were last quarter, and about 9% of GEP. Tech expenses development, about 10% increase from quarter over quarter, and about 16% still. So we could hope these can continue to come down. I mean, they need to come down. General and administrative, huge drop, 23% drop quarter over quarter, down to 21% of GEP. So that's really positive. And total expenses, huge drop. I'll show you the graph for this in a moment, from 81% down to 63% as a percentage of gross earned premium. So really positive. That is my say question for tomorrow: is how are you cutting costs? How are you getting more efficient? How are you cutting the fat from the organization? And it appears that they have been doing that. So really great to see that. So here is a graph of churn, customer churn from 12 months prior as a percentage. Again, a few years ago we're at 40%, and you can see the trend as it's slowly coming down. So really positive to see. Now we're at 23%. Huge. Expenses as a percentage of gross earned premium. So here's our overall expense line. Again, also really positive to see this coming down. We were at 81% of gross earned premium, way too high, but now we're at 63%. So we have to continue to crunch, push all of these lines down, which is what I'm modeling for eventually, that we're going to see that sort of here. We're right here. We're making this drop as we come down and continue to make that push all the way down until we get to a much smaller expenses as a ratio to gross earned premium. In-force premium, as you can see, has sort of plateaued, and we'll see sort of a very slow growth up to probably $700 million by the end of this year. But as I said, and as we've been talking about, we'll likely see that then continue to accelerate in the years ahead. Now, a couple areas of possible concern from the letter is the low guidance growth, which we've sort of talked about already, only expecting around 12% growth up to maybe $700 million in in-force premium by the end of the year. But I think there's good explanation for that, with inflation, with their pricing being changes taking time to actually materialize. It makes sense to slow growth in the meantime until some of those structural changes can take place. The other thing of concern is their full year 2023 adjusted EBITDA was expected to come in around 245 to negative 240 million. And that is concerning. If you look at this last quarter was only 51 or 52 million, you think at sort of worst you'd be at a negative runway rate of maybe around 200 million for the full year instead of 240 million. And you'd think this number should actually be decelerating and improving over time. So you'd expect maybe less than 200 million over the full year 2023. A couple possible explanations for this. One would be they're just sandbagging and they're going to have much better results than they are showing there. I mean, I showed this in my last video, if you look at what they projected in one quarter, the minimum amount and the maximum amount, and then the actual value, they have either been in the range or beat the range on at least, I guess it's the last 11 quarters now. Even this recent quarter was negative 65 to negative 62, but they actually came in at negative 51, so significantly less. Even if we looked at a percent difference from the average that they projected, this last quarter they did a 19% improvement on what they were expecting, and you can see they beat that by 25% before, 15%, 8% for. Some have been right around average. 15-16% has been very common though as well. So you would wonder if they're going to significantly beat that yearly estimate, and that's a very conservative estimate. Vision did ask this question on Twitter, essentially asking this very thing. Pointed this out. Financial controller also chimed in, said maybe they're expecting loss ratios to spike as they ramp CAGR. Not sure how to think about it. So I really do hope that management gives us more context around this guidance on the call. But overall, I thought it was a really good quarter, really, really positive to see in-force premium still growing. Loss ratios are steadily improving. Churn is significantly dropping. Expenses are significantly dropping. Those are all super positive signs for me. Again, if you want to get full access to this model, and also I didn't touch on it in this video, but my customer retention curves as well, feel free to join my Patreon and support the channel. Thanks so much. Remember, it's in the bag.